The housing market is broken and seems to be holding on by a thread. Mortgage rates have surged over the last couple days, bringing the average 30-year fixed for a very well-qualified buyer. We're talking excellent credit, 20% down. National average is 8% for a conventional mortgage. Even the government products are well over 7%, coming in at 7.4% for an FHA loan and 7.42% for a VA loan. This, of course, is going to be problematic for the housing market, and it's certainly problematic for affordability. In fact, home affordability is at the worst level ever recorded in history. Homebuyers now need to earn approximately $115,000 per year as a household in order to afford the median priced home here in the United States. This, of course, was up 15% from just 1 year ago, but it's up 50% from the start of the pandemic. That is a massive spike here over the last 3 years. The national average mortgage payment is coming in just over $2,700, and that is not yet accounting for the spike we recently saw in mortgage rates. Each individual market, however, is affected differently, but there's been some dramatic changes that we've started to see unfold. Markets like Atlanta, Georgia, median sale price is $395,000. A borrower would need to earn about $108,000 per year. That's up 20% on the year. Bakersfield, California, median price is about $370,000. A borrower needs $100,000 a year in income, and that's up 22% over the year. Or we got Boise City, Idaho, where the median price is $465,000. We need an annual income at about $127,000. That's up 9% per year. And then a very shocking market would be a market like San Francisco, where we've actually started to see price declines. The median home price there is just at about $1.5 million. A borrower would need to earn approximately $400,000 per year, and the annual income required to afford that median price home is up 23.2% on the year. And then with the activity that we're seeing play out in the bond market, with inflation numbers being higher than expected, the 10-year treasury yield seems to be pricing in more inflation moving into the future. This is the 10-year treasury yield. It has spiked over the last couple days. We are currently sitting at 4.9%, rapidly approaching a 5 handle. So higher for longer seems to be the theme that is starting to play out in markets. Now, these higher mortgage rates are starting to impact home builders here as well. In fact, the home builder sentiment is at the lowest level that we've seen since January. And this was, of course, after an unexpected drop that we saw in October. And this is the third straight month where sentiment has declined. Home builders have actually done quite well here over the last 12 months. And that was mainly because they were offering things that existing home sellers couldn't do or simply wouldn't do. They provided concessions for design credits. They offered rate buy downs and closing cost credits. In other words, they were playing the market that they had, not the market that they thought it should be. But now they are starting to feel the pinch. In fact, the National Association of Home Builders, the Mortgage Bankers Association, and the National Association of Realtors has urged the Federal Reserve to halt hiking rates. So these organizations actually joined together and they wrote a letter to the Federal Reserve, and they urged the Fed to make 2 clear statements to the market. 1, the Fed does not contemplate further rate hikes. And number 2, the Fed will not sell off any of its mortgage-backed security holdings until and unless the housing finance market has stabilized and mortgage to treasury spreads have normalized. And of course, this is because they need the uncertainty in the markets to shake out and the dust to settle in order to feel more comfortable with where mortgage rates are headed in the future so that they can take on future projects. And the reality with home builders, until they feel a little bit more comfortable, they're probably going to start pulling back some of those projects, or at minimum, slowing down the pace at which they take on more. With the new dynamics of this housing market starting to unfold, I believe there is a silver lining for the potential homebuyer. And we'll talk about that here in just 1 second. But before we do, let's take a look at what sellers are doing here according to Redfin. A few more homeowners are actually putting their homes on the market despite being locked into relatively low mortgage rates. New listings of U.S. homes homes for sale have ticked up 2% since the start of September, and listings haven't fallen as much from summer to fall as they typically do. The total number of homes for sale is down 14% from a year earlier during the 4 weeks ending October 8th, but that's the smallest decline since July. Switching gears slightly, what are home buyers doing? Well, right now they are retreating in many cases as mortgage rates sit near their highest level in more than 2 decades, and the U.S. median monthly mortgage payment approaches $3,000. Mortgage purchase applications inched up slightly this week, but they're still near their lowest level in nearly 30 years. Silver lining in all of this for the potential home buyer out here is that less demand equals less competition. And with the uptick that we're starting to see in inventory, albeit it's a very slight amount, the folks that are bringing their properties to market, unfortunately, they may be in a position where they have to sell, which means they now become a motivated seller. So I believe that over the next 6 to 12 months, there may be this window of opportunity to negotiate some really great deals with motivated sellers.